Today, I'm going to teach you a really cool way to get a line of credit from you for your business in a way that's unconventional. It's a way that you normally wouldn't even think that you're able to qualify for a line of credit. And the cool thing is you're able to get this regardless of credit quality. You're able to get this regardless of revenue. You're even able to get this as a startup business. And I'm going to show you multiple ways to do it. So by the end of this training today, you're going to know what securities-based lines of credit are, how they work, and how you can tap into this funding vehicle to be able to get credit lines for your business. So first of all, let's talk about the basic. What is SBL? What is securities-based lending? Well, basically it refers to the practice of making loans using securities as collateral. When we talk about securities, we're typically talking about stocks and bonds. So we're basically using stocks and bonds as collateral to get funding. Now, you may be saying, I don't have stocks and bonds. That's okay, because there's a really creative way you could tap into other people's stocks and bonds to be able to use this kind of financing as well. And the nice thing about that is that it's easier to use this than going to your family and friends for cash. And look, 75% of businesses get their money initially from family and friends. But I can assure you that it's way easier to get money using this vehicle than it is just asking those same family and friends for cash. So even if you don't have securities, you still want to pay attention, because we're going to talk about another cool way you could tap into this even if you don't have them to still be able to get money. So securities-based lending basically provides really easy access to capital that can be used for almost any purpose. We call this working capital. So when it comes to getting money for your business, there's a lot of type of funding where you kind of have to have a set purpose on what you're using the funds for. So SBA is like that. SBA offers a lot of loans where they're coming in and saying you have to use funds for these purposes, or you have to disclose what you're going to use the funds for. Then there's funding for the sake of what we call working capital, which just simply means that you're able to get money for your business for general purposes, for whatever it is that you may need. So you can buy real estate, you can invest in a business, you can use it for anything. We actually had a client that used it for his bar to be able to get money to actually expand and grow his bar. Okay, so the only restrictions to this kind of lending are other securities-based transactions like buying shares or repaying a margin loan. If you're doing other things with those securities, it creates a complication. It's that way with any kind of asset or collateral-based lending. So when we look at this, we call this asset or collateral-based lending because basically we're providing an asset, in this case it's securities, to be able to turn around and get financing. So it always creates a problem if the asset you're leveraging to get money is being leveraged another way, right? That doesn't matter. So if you're getting equipment financing and borrowing against equipment you already own, you can't really do that if you already have a lien against that equipment. It's a perfect example. So the only really restrictions to this type of financing doesn't have to do with your credit, doesn't have to do with being a startup, revenue, high-risk industry, any of those things that prevent you from getting most kinds of money. The only restriction here is if that security is tied up another way. Okay, so generally this is offered through large financial institutions. It's often commonly used to acquire businesses, real estate transactions, amongst many other reasons. But I mentioned these two because they're big. And so this is ability to get a lot of money that you need to grow a business at a very low interest rate. And that's why it's commonly used to be able to buy businesses. It's oftentimes used to buy real estate and things that are generally more expensive. So lenders determine the value of the loan based on the borrower's investment portfolio. So ultimately, they're looking at the current value of the stocks, bonds, and securities that you have. And in some cases, the issuer of the loan may determine eligibility based on the underlying asset. It can end up approving a loan based on a portfolio of U.S. Treasury notes rather than actual stocks, if that's what's being pledged. But the bottom line is they're going to look at what the current value of your asset is, the current value of your securities as it is today. Now, once approved, the borrower's securities, the collateral, are deposited into an account, and the lender becomes a lien holder on that account. If the borrower defaults, then the lender can seize the securities and sell them to recoup their losses. This is asset-based lending in general, okay? So when we talk about asset-based lending, it's phenomenal. It's better than any other kind of money you're ever going to get, and here's why. Because the lender can directly pull and take the asset back if you default. So if you default on a $100,000 credit line, then they take $100,000 in stock. So it's very easy for them to recoup their money. And the benefit to you for that is that means they don't care about your credit quality. They don't care about your revenue. They don't care about being a startup. You get really low interest rates and phenomenal terms on this kind of money, even with credit issues, because they could directly take the asset back if you default. Now, the nice thing about using guarantors, people that are family members, friends, and tapping into their securities for this product is the only way they lose is if you default. So let me give you an example. If I go to my dad and say, I need $20,000 to get my business off the ground, if my dad gives me that $20,000, he has tax penalties and all kinds of ramifications for withdrawing it from wherever he withdrew it. And then he's not earning interest and he's all these negatives. And then if I default, then he lost the 20 grand anyways. With this kind of financing, I can go to dad and say, I need 20 grand, but here's the deal. I got this great program called securities-based lending. You still get your stocks. You still keep them in place. You still earn your money. The only way you lose is if I default. So it's lower risk for the person if you're using their securities, their stocks and bonds. And it's really a low risk for you as well, because the only reason that you're going to lose here on those stocks and bonds is if you actually defaulted on the loan, the credit line. So in general, borrowers can get cash in just a few days, typically 72 hours or less. You're able to get this kind of funding, and it's very cheap. And we'll talk about interest rates as well. The borrowers you basically charge generally a variable rate based on the 30-day London interbank offered rate, or the LIBOR. So that's what they actually calculate the rates more on, is the current LIBOR rate. So interest rates are typically 2 to 5 percentage points above whatever the LIBOR is at that given time. And LIBOR is derived from an average of daily estimates of borrowing costs supplied by a small group of large global banks. I won't get into LIBOR, right? That's a whole other webinar. But all you need to know is you can easily Google what LIBOR is, and you're going to typically pay 2 to 5 percentage points above LIBOR. You can get the money fairly easily, as we mentioned about, fairly quickly whenever you need it. And you could potentially avoid capital gains taxes from selling the securities. And that's, again, the problem, right? Is that if I come in and I use my own stocks and bonds and I sell them and I liquidate them, well, then I have all kinds of tax ramifications, right? And I'm gonna have to pay taxes on those, let alone I might have to pay capital gains. Same thing if I borrow money from somebody else. If I'm going to need money from my dad, he's gonna go liquidate stocks to get that money. Then he's gonna have all kinds of tax penalties. This allows you to borrow against that asset without accruing those tax penalties. So it's a really nice way of using money that's in security, stocks and bonds, and being able to use it for the purpose of growing a business, but not having to pay tax ramifications, lose the interest, all the things that would happen if you actually liquidated those. And Derek says, what if you have a business that has aged? Can you still get trade lines? You absolutely can. As long as that business is active and you basically make it active, you'll be fine. And Facebook user says, can this method be applied if stock is common shares? Yes, I believe it can be. Yes. So the answer to that is yes. If you'd like for more information, you can go to creditsuite.com/get funding, fill in the information about the stocks that you have, and then our funding team will get on there to look at your specific case to see if that can work as well. But common stocks are usually accepted. And we'll talk about more stocks that are accepted here in just a couple of minutes. So typically lower rates than other forms of credit, no setup fee, no cancellation fee, ability to borrow a large percentage of your eligible assets. We'll talk about the percentage here in a minute that you're able to get. So a lot of benefits from using this. So basically, this offers access to cash within a couple of days at very low interest rates, as we mentioned. These rates are often similar to home equity lines of credit, and it works best when you're using it for short periods of time. But again, it can be an emergency loan, it can be a bridge loan, but it's basically a working capital line of credit. So you could use it, pay it off, reuse it as ever you see fit. It also offers an additional lucrative income stream without much additional risk for lenders, which is why they do it. Because if you think about it, they can lend you money, take the stocks. If you default, they really have very small risk, and they can still charge an interest rate and rate of return. And they basically have almost a no lose situation, because if you default, they just take back the asset. And again, as I mentioned, the liquidity of that asset is what's being used as collateral. And it can help to mitigate much of the credit risk associated with traditional lending. Look, traditional lending, they're usually going to look at your cash flow, your credit, and your collateral, all three for big banks. Most of the lending online that we see through fintech lenders or marketplaces, they're lending you money based on your revenue, based on your credit quality. It's one of those two things. This is a form of financing that's looking at collateral, not credit, not cash flow. So again, it's lucrative for the lender because they're not taking on much risk. And it's also nice for you because even if your credit's bad, you're still able to get really low interest rates. So you can still stay invested. You can still earn interest rates. You can still earn the rate of return you're getting on those stocks now. So the nice thing is that instead of liquidating the stocks, not earning interest and having tax penalties, with this, you're using it as an asset, you're still earning interest on it, and you're still avoiding tax penalties. So it's a nice way to tap into that asset, whereas typically you're not necessarily able to do so. So as I mentioned, you're pledging securities. The value of that is kind of out of your control, right? It has fluctuations the way the stock market does. So decline in the value of your securities could result in you selling your securities to maintain equity. Hence, you may suffer adverse tax consequences as a result of selling the securities, which is why you don't want to typically sell securities. If you could tap into an option like this to still keep them and get what you need. So again, the growing usage has led to concern due to its potential for systematic risk because again, as we just saw with COVID, a lot of stocks actually have dropped. So a lot of people have looked at, is this still a viable way of financing? But even through COVID, we've seen that it absolutely holds up. It absolutely is. So this type of lending is not tracked by the SEC. It's not tracked by the FINRA, or which is the Financial Industry Regulatory Authority. Still both continuously warn investors of risks involved in this market. You need to know that you could lose, especially if your values completely drop out. Then you might cut, for example, that line of credit down as a result, because the values of your securities have all dropped as a result. Okay, but then again, that's the risk you have of anything to do with securities as well. Okay, and Enrique says, love your content. Thanks, man. I'm glad you've learned a lot, because I'm trying to teach you as many cool ways to get money as I could possibly do. So when equity and fixed income markets perform poorly, which is often cyclical, as we know, the market value of many assets can hit low levels that were previously unthinkable unless the borrower has a large supply of liquidity. But again, these are just things that we're basically saying that, hey, the stock values can drop, so it's something to keep in mind. So a bank calling in the investor's collateral could trigger forced liquidation of the borrower's assets. So what do we mean by this? Credit lines can often be called due by the lender. So if a lender gives you a credit line for $500,000, the scary thing is they can call that line due at any time, and you have to pay back that $500,000 within a set period of time. So keep that in mind. If your stocks plummet, then there is a possibility that the lender, the investor, actually says, hey, we need you to, we're calling this due, you owe the $200,000 that's there. And then you might have to liquidate the stocks to be able to get the money to actually pay them off. So it is a possibility, but then again, that's a possibility with any line of credit that you should know about. In such cases, the borrower does not have the option to buy and hold. Then in that case, you have to actually pay them back, whether it be selling the stocks or not. So while the specifics will depend on the lender, the following are securities which are often accepted. I'm not saying that they are, but they typically are. Marginable equity securities. This includes EFTs, exchange traded funds, and most mutual funds, cash and cash equivalents such as certificates of deposit, fixed income deposits. This can include most investment grade corporate, treasury, municipal, and government agency bonds as well. These are the kind that are oftentimes included in this. Now, oftentimes, this type of financing offers a powerful and flexible way for a new or existing business or franchise to basically leverage assets and stocks and bonds to be able to get money very quickly. And it gives you more control of the performance of your retirement plan assets, because not only are your stocks in place, think about how smart this is if you really think about it. I mean, just think about how smart this is. You have money in stocks and bonds, right? You're earning an interest rate and a rate of return. Now you're leveraging the stocks and bonds you have, still earning the rate of return, still keeping them invested, getting a line of credit against it, and leveraging that to then grow another asset, which is basically your business. So life insurance policies work this way as well, whole life, where they'll actually let you borrow against the whole life policy. And I've got people out there like compoundinterest.com, Curtis Ray. Curtis, this is what he does. This is their entire business, is they actually will go out and then they'll get you a whole life policy. You borrow against the whole life policy at like a 4% interest rate, and then they invest in things that give you a 7% return. So it's like you're borrowing against the asset and leveraging and hedging that to basically then even get even greater returns. Now, of course, with any kind of investment, you could lose, right? You could put the money into a business and the business can fail. We all get that. And we all understand the statistics of failing businesses as well. But if you think about it, it's very smart. You keep the stocks invested, no tax penalty, still earn interest, and then leverage that even further with the line of credit to be able to grow another asset, which is your business. So it gives you complete control over that asset. Now you can be, maybe complete control is not the right word, but you get what I'm saying. It gives you more control and more ability to earn money off that asset. Now you can be approved for as much as 90% of the value of that security, the stocks and bonds. Most stocks and bonds are actually accepted, and you keep all the interest and appreciation, as I mentioned, and there's no prepayment penalty. Easy to qualify. You don't need tax returns. You don't need bank statements. You don't need tax returns. You don't need, your credit does not matter either. All they're going to want is basically like the last few statements from your stocks and bonds, from the securities. They want to see how those securities and are performing. So they're going to ask for like the last 90 days worth of statements for those stocks and bonds. And if their stocks and bonds have a value over $25,000, then you can typically qualify for this program, regardless of cash flow, regardless of industry, regardless of being a startup, regardless of credit quality. Those things really just do not matter. So lenders are not looking for, nor do they require good credit quality, as I've mentioned. Okay, credit history is just not important at all with this. And they're not going to want you to have bankruptcies or foreclosures in the last 5 years. But outside of that one exception, they don't really care about your personal credit. So credit history is not used even to determine the loan to value. The stocks and bonds and quality, and basically the type of stocks and bonds you have will be used to determine the loan to value, which is, can you get 80% of those stocks, 90%, but 90% is common that you're able to get. And the lender reviews your security statements, as I mentioned, and you can receive your initial approval and funding in a couple of weeks or less. We've seen this happen even in as little as just a few days. So 24 hours to typically get pre-approved, no penalties for rollover, easy security review for approval, no application fee. So fast, easy way to be able to get approved. And as I mentioned, you're able to get up to 9%, 5% interest rates are common. We talked about LIBOR. 5% interest rates are pretty common in what we see on this product. So now bring this full circle. You're getting a 5% line of credit, even as a high-risk industry, even as a startup, even with the credit issues, using your securities or somebody else's to qualify for financing. I mean, you can't beat that, right? It's hard to get even that kind of interest rate with an SBA full doc loan. This is basically a no doc loan besides those security statements where personal credit doesn't even matter, okay? So it's something that you really need to keep in mind. Okay, so to recap, and before I do, let me make sure I answer Brandon's question. It says, catching a little knowledge at work. Thanks, and always enjoy the business credit content. I appreciate that, Brandon. Thank you very much. And it's always good. I like to be learning in any environment, especially when I'm working. So to recap, this is a really low interest line of credit you're able to get for your business. You're hedging your own securities as collateral or somebody else's. You get money quickly. The interest rate is low. You're able to get as much as 90% financing against the actual stocks and bonds. The decision is fairly quick, 24-hour pre-approval. Funding is as little as 3 days, and sometimes it might take a little bit longer. But again, just a really fast and easy way to get money for your business. Now, if you'd like to get money for your business, feel free to give us a ring, 877-600-2487. Go online to creditsuite.com/get funding. Keep in mind that we pull together all these funding sources into one place. You don't pay us fees ever. We don't charge you any fee. The lender oftentimes pays us a referral fee. That's how we get paid. But we do so much volume in loans that we get a discount from those lenders we pass on to you. So bottom line is, you get somebody to help you get access to all this money, and it literally costs you nothing. As a matter of fact, you get a better deal because we take our volume pricing and just give you the same thing. So basically, you're getting a lower rate because you're coming in on the tail end of our volume that we do with the lenders, and then we're giving that same interest rate to you. And we build a business blueprint so we can help get you in to the kind of SBA loans and the longer-term lower interest rate financing you'd like to. We're going to get you the money you can get now, and we will graduate you to other loans like SBA loans as well. So if you're interested in that, give us a ring, 877-600-2487. Get approved online at creditsuite.com/get funding. If you got value here, do me a favor, like this video, subscribe on whatever channel that you're actually following us. That shows the other social platforms that this content's valuable. And if you like what we went over today, we go live Tuesday and Thursday at 1, 11 o'clock on Wednesday, all Eastern time. You can access our social channels at the top right of our page, creditsuite.com. We go live on our LinkedIn page, our Facebook group page, our Facebook page, as well as we go live on our Twitter channel as well. And we have daily tips on a lot of our channels, including Instagram. You can access all that at the top right of our page, creditsuite.com. So now you know how to use securities of yourself or somebody else to be able to get money to grow your business. Think about investors. Think about other people that would want to invest in your business, and you could tap into their asset to be able to leverage to get the financing that you need. A lot of creative ways to use this to get money for your business. So I will be back tomorrow where we talk about more cool ways to get money to grow your business. If we can help you along the way, give us a ring at 877-600-2487. On that call, we will pre-qualify you for funding. We'll do a funding assessment to see how fundable your business is. And we'll help you get your business credit reports for free and review those with you. All that happens on a call with us. So if you'd like to know about all the money you can get right now, give us a ring at 877-600-2487. That's 877-600-2487. Thanks for tuning in. I look forward to seeing you on our next training where we teach you more cool ways to get money for your business. Thanks. Have a great day.